All right, well, Mr. N. Jayakumar is with us, Managing Director and Chief Executive Officer at Prime Securities. Jake, great to have you with us here. Good afternoon. Thanks for joining us. A tinge of caution needs to be inserted into the conversation, into the commentary out there, according to you, Jake, or you think it's going well and will continue to go well?
More than a tinge of caution. I think there's significant froth that's built up in the small cap end of the market. I think IPOs also are beginning to quote at pretty ludicrous, valuations post their listing. So my own feeling is both the IPO market to a lesser extent, but definitely the small cap market is littered with a lot of froth. The mid cap market possibly not as much, and certainly if there is comfort, it's probably only in the frontliners where you're hoping for certain sectoral pickups to actually buttress the Nifty. But inevitably, if you see the overall sentiment in the market, there is a global sort of consensus building up of an India must be a market to invest in kind of consensus. It's true for Indian, retail and HNI population, which so far has been cautious, but in the last week, 10 days, I've seen them, I think, being afflicted by FOMO, wanting to come into the markets and be in some end of the market, if you will. So there's a lot of, unconvinced, but must be in the market kind of buying that's going on. I think the market is definitely heating up. Because of global consensus, so much money coming in, maybe we are heading for, and I think there could be a sort of a small parabolic kind of rise if this is not already seen as a sharp one, before the market settles to actually start correcting. I think, this entire thing about bad results, good results not affecting price moves may be about to end. There will be decided, movements in market, in stocks post results, which has so far not happened because I think there's a flood of money that's coming in from overseas investors who've been left out, those who played China, those who played going back to the US, and now feel that the Indian market hasn't corrected, therefore need to come back here. So I think this last leg is seeing a lot of money that on its own either chose to go out and therefore is coming back. A bit of a capitulation, sort of short capitulation move. Maybe we haven't seen the absolute fag end of it. Maybe we are 500-700 points in the Nifty away. But certainly I think the markets will be well served by a correction. Valuations are getting rich. But there are pockets, and in all markets there will be pockets where you go to. And I think the large caps are giving a lot more comfort there than the smaller mid caps.
Jake, hi, good afternoon. Exactly on that point. So I just wanted to ask you precisely this, that how do you sort of keep your sanity against this wall of money that's hitting? Because it could keep coming in, right? Because of the China factor that you mentioned as well. So look at spaces like defense or electronics, the EMS guys. These stocks are quoting at 40, 50, 60 times forward earnings. So which are the pockets? Are these the pockets, or is there some other space where you would advise either profit booking, straightaway profit booking, or at least a complete halt in entry, irrespective of the long-term potential? Do you see such spaces or pockets in the market?
Even in unbridled bull markets, there are corrections which can be short and sharp. The defense space clearly is as frothy as you can get. Every order, every execution, every technology agreement, if you will, over the next few years has been factored in. My own sense is markets don't move like this. It's because these spaces did not have allocation earlier that you have money walking in the way it is. There's a lot of HNI money that's walking into these spaces, and 50, 60, 70 seem to be par for the course. I'm still, in that sense, an old school guy who believes that anything beyond double-digit, mid-teen kind of PEs needs a second, third, fourth, maybe a 15th look as well. And therefore will inevitably miss out on some of these extremely rich and frothy sectors. Not a problem. I think whenever there's a sectoral pickup like chemicals a while ago, defense today, those who got in initially either by design or by default end up making the most amount of money. And if it's a 3-year run, 80% of the gains come in the first 6 months. And after that, really, you're desperately clutching at straws to justify valuations. Are these sort of structural bull markets in these spaces? Difficult to say. In chemicals, for instance, there has been sharp pullbacks, and now people are picking up individual spaces to get into. Wherever there has been a factor like because of China or because of certain duty concessions or because of certain reasons that some sectors have flourished, and if that is a transient reason like solar, for instance, where the US now suddenly over the last 2 years put a halt on all kinds of Chinese imports. The biggest beneficiaries were Indians or the Indian companies. And now, while Indian companies are seeing order books swell, you have the US government giving adequate and more shops for manufacturing to be set up in the US. The moment these manufacturing capacities come up, again, you could have the same problem where initially it was China, now it could be the US, because the manufacturing and the shops there are far richer than what's available in India. So we have to be careful where there is a sectoral play which could be a short period of time. There's an interesting phrase which markets mention or certain section, which is called profitable death. Profitable death refers to something like, when there's a mad scramble for, let's say, ESG. People say that we must absolutely junk coal and other kinds of, black assets, if you will. With the result, some of the coal assets started getting sold off at 1 time EBITDA or 2 times EBITDA, which means that if you look at the business metrics, if you bought this, 1 year's cash flow could justify your purchase. So these are called profitable death kind of scenarios where these are hugely profitable for 1 to maybe 2.5 years, and then at the end it's like a cliff, the profitability just falls off. So I think we've got to be careful that a lot of spaces in the market are developing these kind of characteristics. And technology, especially with AI coming in, is continuing to be a huge disruptor of businesses. So I think as a longer term investor or investor for long, if grey hairs is the only way to explain my being around for long, I think I'd be very happy going back to businesses that have seen cycles, businesses that are adapting, whether slowly or otherwise, and go back to picking stocks which I still think have value. They are valued much less in my portfolio, the kind of stocks that I have. And I'd like to,
if I could, sorry, Jakes, just to come in over there, if I could just ask you that, is this the same argument or the same reason that's pushing IT stocks higher? Is it just the fact that there's so much liquidity coming in, or do you see IT differently, that perhaps the valuations are much better and there's no need to write off these companies, given the extent of demand that's perhaps just been delayed and not postponed indefinitely?
Well, IT is a particular case where there is no debt on balance sheets. These are liquid balance sheets, profitable companies. Maybe growth has come under a bit of a cloud. I think IT has another factor, which is we haven't still seen the impact of AI on services. And my own assessment is that the AI impact would be much, much more pronounced than we've seen so far. What you've seen right now is just some deferral of spending, and some of the growth rates have gone down to middling single digits or low single digits. So IT may be suffering from that perspective, that you haven't seen too many sectors which have this level of cash, this level of dominance, and yet because growth comes down, they're down to multi-year lows in terms of multiples. So IT I would view differently from other businesses that flourish only because of certain, let's say, concessions that are given. And I keep giving solar as an example for that. There aren't too many listed plays in this. And the other thing would be things like coal, etc., where where the movement out of traditional fossil fuels has meant that people have just kitchen sunk, if you will, the entire portfolios. You had people like BHP Billiton listing their coal assets at 1.5 times and sacking it out, only because they wanted to be seen as ESG compliant, and people made a lot of money in that. So there are ways to make money, but I think we need to be cautious that markets are definitely richly valued. So you will obviously not naturally ask me if I'm recommending getting out of the markets. In fact, not really, because I think spaces like pharmaceuticals could be a big sectoral shift. We're seeing this. People have been underinvested in, again, a space like IT, which is export-driven in many senses. It's got a lot of cash, very low on debt. It had problems recently about FDA approvals. It had problems on pricing in the generic space. Some or all of these have been correcting. Approvals have been coming much faster. Indian companies have learned to become more compliant. Pricing pressures have dramatically eased. And suddenly generics is in big time demand both in Europe and in the US markets. So my feeling is that pharmaceuticals gives you the comfort of valuations. It's got the local PLI flavor as well thrown in one or two cases. It's got biosimilars. Many of these, certain brokerages, including us, not brokerages, certain research houses believe that biosimilars could be the big differentiator going forward. And there are companies with portfolios that are biosimilar stacked. So I think we need to be a little more deep diving in our research approach. This is not going to be pick up darts and throw it and you make money. I think those days are actually pretty much, to my mind, behind us. And therefore, I urge caution on that front. I think with the capex and the capital goods bullishness that we are seeing in terms of orders, I think metals very inexpensively valued. So these will not give you the kind of returns that new age economies or new age companies make. But I think these are solid returns in the market, which some of these well-integrated metals companies could. As I talked about pharmaceuticals, I've talked about companies. And if India has to grow the way we're all seeing this, financials, they have to be at the cornerstone of growth. So whether it's PSU banks or it's some of the smaller private sector banks, I think there's a lot of opportunity in the markets, but we need to be clear that we approach this with a clearer head than has been made possible in recent times, where people are now calling up and telling you of their successes in the market. And when people start recounting successes, I get a little worried.
All right, Jayakumar, well put together and good to hear that. Thanks very much, Jayakumar, for joining us and running us through what you're making of things at this point in time. Well, we're up, 40 points, 19,750. And so it's a bit of back and forth. It's not one way, not up, not down, but a more flattish kind of day so far. We'll take a quick commercial break here. As always, we'll get you what's happening in dealing rooms. Nimesh gets us the stocks to watch and, of course, the chatter. Our trade calls, short-term trading ideas with our technical experts after that are lined up as well. Stay with us.